Okay, this is gonna be a very simple, like, overview of what the Red Bull model is. This is my Red Bull trading model. Over the past 4 months, I want to say, maybe 5 months, it has a 84% win rate. Couldn't do math for a second. Yeah, there's a lot of technical stuff in it. I'm not gonna go over them individually. I'm just gonna go over what the model is, how it looks like, and how you can trade it. I'll go over like the individual tech, literally like in a later video. But yeah, okay, let's go over it. So, step one, identify your bias. What high time PD arrays are we? Okay, first of all, let's just look at what the Red Bull model looks like. So, the Red Bull model has two scenarios, bullish or bearish scenario. We want our higher time frame, our 15-minute, our 1 hour, 4 hour, or daily time frame. Probably not your daily, but like your 1 or 4 hour and maybe 15-minute time frame to look like this in a bullish scenario. And like this in a bearish scenario. If any of y'all are familiar with Justin Werlane's Forever model, at its core, the Red Bull model is that. There are some bells and whistles that I've added and improved upon, but at its core, it's Justin Werlane's Forever model. So check that video if you want to see it. Anyway, this is the bullish and this is the bearish scenario. Red for bearish. So in the bullish scenario, we want to see a higher time frame fair value gap or PD array to be respected. We want to see a sweep of high time frame liquidity. Ideally, market opens like right here, sweeps that low, and we see our entry condition, which is an inverse fair value gap and change in the state of delivery. Off of this, we put our stops to low and we target this external high right here, and that's our trade. That's what we want to see. That's basically the model. That's it. That's literally Justin Werlane's Forever model. There's some more bells and whistles that I'll go over with, but this is the core of the model. I'll show you guys over here on the bearish scenario. Ideally, we want a fair value gap, or any PD array could be an order block. I've been experimenting with those recently. We want to see respecting, then we want to come up, sweep of liquidity, like right there. Market opens like there. Inverse fair value gap change in the state of delivery. Take stops over there and take profit at that external low. This is how the model plays out in a bullish and a bearish scenario. Remember, this fair value gap, this liquidity, we want to see it on the 15, 1 hour, or 4 hour time frame, maybe even the daily. Typically, it's going to be the 1 hour, 15-minute, or 4 hour time frame. Okay, so now let's go over what each component is specifically on the model. Actually, let me just move all the drawings. Okay, let me draw over the model. Okay, so step one, what high time frame PD arrays are we respecting versus disrespecting? This is Blake theory. So essentially, it's this guy, this trader. His name is like Blake. His model defined his bias. He focuses on PD arrays like fair value gaps. Which fair value gaps are we respecting, like holding, and which fair value gaps are we disrespecting? In essence, creating inverse fair value gaps out of. So if we're respecting a lot of bullish fair value gaps and creating bearish inverse fair value gaps, that means we're bullish and want to look for longs that day. Then there's this. This is basically how you should be trading, finding targets. It's called external liquidity to internal liquidity or internal liquidity to external liquidity. I'll go over more in detail about this, but right now I'm just going over a simple overview of the model. Essentially, you want to trade from internal liquidity towards external liquidity, or you want to trade from external liquidity towards various internal liquidities. And this is what internal and external liquidities are. Go over that later. Lastly is something that I've developed. It's called session narratives. I'll go over this later when I cover quarterly theory and like daily profiles, weekly profiles, session profiles, hourly profiles. I'll go over all that later. Essentially, the sessions tell a story of price. Yeah, sessions tell stories of price, and we can use these sessions to see what they're telling us and then predict where price will go based on what these. I'll go over that later because it's pretty complex topics. Next, high time frame buy side and sell side liquidity. Within those high time frame fair value gaps that we marked out, we want to find internal liquidity, and we want that internal or external liquidity to get swept so we can trade towards internal or external liquidity. It's like I showed you here. It's like that scenario I drew out where you went like this. This is the high time frame PD array. This is the liquidity that we sweep, and that we continue higher towards the external liquidity. This is internal, this is external liquidity. So that's what I was talking about here. Then high time frame fair value gaps. Typically, we identify the liquidity first because that's always the easiest to find. We've identified the liquidity on the 5, 15, or on the 15-minute, 1 hour, or 4 hour time frame, and then we look at those similar time frames. It doesn't always have to be on the same time frame, but still high time frame for a fair value gap, order block, any sort of PD array to reinforce this, to layer on the confluences to increase our win rate. Then, as I see here, I said fair value gap. You can also use order block. Ideally, you want to use both. Always great. ICT opening range gradient. This is a new concept that he's implemented himself. He's taught it recently. I think it was in his 2025 model, but it could be more recent in his 2026 model. Essentially, it is the gap. I'll make another video on this. Essentially, it's the gap between regular trading hours and electronic trading hours, because price closes at 4:15 regular trading hours and then opens again at 9:30 in regular trading hours, leaving a gap. And we want to mark out that gap using a gradient, essentially. And these are the levels of said gradient. And each of these levels can be used as points of interest where we can take trades off of. And as you can see here, these are some rules or just details regarding it. If New York Open is above the settlement, the gap is premium. Looking for longs, not exclusively, but it's just a good way to layer confluences. We're not, one confluence doesn't determine everything. It's just layering confluences. New York Open is below settlement. The gap is discount. And this one is pretty discretionary, if I'm being honest with you. If the gap is greater than 120 points, as you can see here, if we measure out the gap from top to bottom, this gap is 363 points, which is greater than 120. Price is unlikely to completely fill it on the day it is formed and will most likely reflect either the 0.25 or 0.75, depending if it's premium or discount. For example, as you can see, the gap is 360, which is greater than 120. So if price was to open here, which it would, since it's the gap from settlement to New York Open, price at most would just go into this 0.25 level, maybe even wick past this, but it wouldn't wick past the 0.5 level, but it won't close, and then it'll continue higher. That's what the large gap tells me. Okay, what next step? And now it's time for a confirmation. So honestly, like, this stuff is a bit extra. You don't really completely need all this stuff, but it's good to know. Once we identify this on the higher time frame, let's say market open is right here. We identify all this on the higher time frame. What we want to see, now we're on the lower time frame, the 1 minute, the 3 minute, the 2 minute, the 5 minute. We're on the lower time frame. We want to see the leg that sweeps this liquidity. Once the liquidity is swept, in that leg on one of those low time frames, we'll create an inverse fair value gap or a fair value gap. And I'll show you an example later, don't worry. It'll show you a fair value gap. And with that fair value gap, we want to see that get inverted. Not only do we want to see it get inverted, but we also want to see price close above a previous order block, a change in the state of delivery. So imagine this on the lower time frame, right here. I'll draw it out right here. Bam, bam, bam. So that previous liquidity level, that high time frame liquidity level right here, price moving down to take it creates this fair value gap right here. And this creates an order block. Imagine there's like a little bit more like that. So this whole manipulation leg is what it quantifies as a change in the state of delivery. We want to see price close above that to have a valid change in the state. Remember, price has to close. So once we have an inverse fair value gap and that change in the state of delivery, we can take our entry off here. Stops at the low, slightly below the low to avoid any slippage or any fake outs. And then you target your external liquidity wherever that may be. Now, one thing to note is sometimes price might move really high and you might not get a good RR. It is fine to wait for price to retrace to 0.5 of that range. Let me switch to this. It's fine to wait for price to retrace to 0.5 of that range. Typically, if it's a good break, it'll also form another fair value gap, a bullish fair value gap of this leg, and you can take your entry off of that. And yeah, that's what I was talking about, the inverse fair value gap, the change in the state. This is just how you set your stop loss, this is your take profit, and this is your break-even rules. These are variable, and it's not really something that is set in stone. That's the whole point of discretionary trading. Let's go look at some examples. These are some trades that I have taken. Let me mark out 9:30 over here on Tuesday, May 12th. So we start on the 4 hour. Well, actually, let's start on the daily. Let's be proper. As you can see on the daily, before we're very bullish. I'll teach you about like candle range theorem, so you can how you can find your daily bias really easily. I'll teach that later. But anyway, as you can see, we're bullish. We're closing above previous day highs multiple times. This one we close above that, but we do slightly close above that previous day high. So yeah. Now hop on the 4 hour. What do we see before market open? Price starts to continue lower. What PD arrays are we respecting? What are we disrespecting? Right now, there's no PD arrays here. However, there's these fair value gaps that we are disrespect. Oh, well, actually, we don't see this candle yet, so never mind. Don't listen to me. But we create this bearish fair value gap right here, pre-market. Let's go down to the 1 hour, so you can get a clearer view. 1 hour, we're going to finally start looking at our sessions. Okay. So not only do we have a 4 hour bearish fair value gap there, we also have this order block right here. The candle open is here, and we draw out the midpoint. I'll go over order blocks later, but you can just trust me on this. This is our order block. So we have two stacked confluences here. Next, we go down to 50-minute, and the 50-minute is where the ideal place to read your session narrative. So from the session narrative, we can see that Asian moved bearish, London distributed through Asian low, as you can see here, and we do not reverse off of it, signifying that we want to continue bearish order flow. But due to the fact that we distributed bearish without taking any liquidity, we're going to want to take either London high or London low in order to facilitate a move. So the two scenarios I would be looking at is a bullish scenario where we take London low and then continue higher towards all-time highs, or a bearish scenario where we take London high and we continue lower to some other target down here. Probably this low right here. Let me mark this. Okay, that low right there. So I will go more into session narrative, but that's how you read it. And now I said something about a bullish scenario where we take this London low and we continue higher. Why would I not be looking for long? Just because I said, according to Blake theory, on the 1 hour, we created a bearish fair value gap right here, and we're disrespecting. We created a bearish fair value gap, and we're disrespecting bullish order flow. As such, I would, even though there is a possibility for longs, I don't want to be looking for longs because I layered multiple confluences. That's why on my Red Bull model, let me mark it. There's multiple ways to identify the biases. 3, in fact. This one's not really, it's just a rule, but there's 2 main ways. There's this one and then this one. So even though the session narrative is telling me there's an equal chance for there to be bullish and bearish price action, the PD arrays are telling me that it's mainly going to be bearish. So then we go down to the 1 minute and we wait for market to open. Okay. So market opens and immediately goes and hits London high, as I said it would. Price would take either London liquidity. As you can see, we take London low pre-market, but as you can see, we don't really reverse off of it. So it doesn't signify any reversal in bullish order flow. So price opens, we chop around and then shoot up to take this. Did we create a fair value gap, a bullish fair value gap going to take this? Yes. Right here, we create this fair value gap. What else do we create? We have this change in the state of delivery right here. 60. Okay. Where is my settlement price? Hold up. I'm going to show you the opening range. Yeah, okay, settlement is up there. So another sign that hello? Okay. Okay, settlement is the second line. We can draw our from our opening range gradient from settlement to the. That's not the correct market open. This is the correct market open. There we go. Opening range gradient. I like to lock it so I don't accidentally click it. Anyway, here. So we have our inverse fair value gap and a change in the state of delivery. Furthermore, the opening range gradient, as you can see, is more than 120 points. As I say before, if the opening range gradient is more than 120 points, price is unlikely to completely fill it and will most likely respect either the 0.25 level. So as you can see, price, when it goes up to manipulate this London high, what does it do? It respects these levels. At most, it'll go up to this 0.5 level and wick through it. It'll never close through it. If it does close through it, then my bias for bearish was wrong for the day and I don't trade. As you can see, we're respecting this. So I'm more than comfortable to take a short position off of this change in state, the candle closure here. So we enter on the open of the next candle, put our stop slightly above the high. I would put it at the 0.5 level. Then we target that liquidity that I marked down below. For a 1 to 4 hour trade, you might be wondering if I go break even. I typically do not go break even in my trades. I rather just take partials. For example, I would take a partial this 8 a.m. low. But yeah, that is the redbull model. I will make more videos about more examples because I know this was just one example. But yeah, that was pretty good. I'll show you the model again. We'll just go over it real quick. It's a very simple model. Well, not really, but it's a good model. I like to think so because I kind of made it. But at its core is Justin Werling's Forever model. Go look up that YouTube video for like a better explanation. He's a better trader than I am. But yeah, that's it. These are my rules. You can like look at this stuff. Some of these rules have actually changed and I should probably update them. But yeah, very good model. I'll make more videos about it. No worries.